particularly within Canada right now, there is a need for more investments. We have, opportunity. There's a lot of demand for real estate investment in Canada. It's tough to compete. It's a small market, so it's very tough to compete with some of the, say, tax-exempt investors that are in Canada that don't have these tax issues that I mentioned. And so there is certainly some work to do there with respect to tax policy in our own country, but I remain optimistic that we're going to get there.
Joining me today is Neil Chander, Partner of International Tax with RSM Canada. Neil, thanks so much for joining us today.
Thanks, Matt, for having me.
Now, you were on a panel here at REITwise focused on cross-border tax issues. What are the top 3 tax issues for U.S. REITs investing or looking to invest in Canada?
I think the consensus really was that, just the general overall complexities of Canadian tax and particularly around repatriation of profits out of Canadian into a U.S. REIT is quite onerous and does have, compared to a lot of other countries, tends to be a little bit higher in terms of that exit tax. And so, that tended to be something that, needs to be looked at and mitigated as much as one can. I think second of all, our interest limitation rules that we have in Canada that are similar to the U.S. rules in terms of restricting interest and financing expenses for U.S. REITs or any foreign investor investing into Canada to 30% of their EBITDA. The difference is in Canada, there's no exception for real estate investments. So this causes a little bit more of a challenge and a little heartache more when underwriting the investments in Canada for non-residents such as U.S. REITs. And then, of course, Pillar 2, which is sort of a hot topic, that's the global minimum tax that the OECD has introduced, that Canada has now put into their legislation effective 2024. And that, as we may know, the U.S. has not adopted that into their regime. And so, we talked a bit about the retaliatory sort of issues that have come up as well. And so that just creates a little bit more uncertainty, complexity in the Canadian investment into real estate sort of scenario. But with proper structuring and proper planning, there are ways to kind of mitigate and deal with those sort of challenges that people face.
And picking up on that, what are some of the ways that U.S. REITs can structure more efficiently to manage some of these issues?
Yeah, that's a great question. It feels like the general theme of the conference this year is there is a lot of uncertainty for sure. Things seem to be changing almost on a daily basis. You wake up and something else is happening. So that makes it tough to plan for sure. I always sort of advise my clients that in a situation like this where there is uncertainty, don't make any rash decisions. Think it through. Be on top of a lot of the key issues, real time if you can. Talk to your advisors. Touch base with a lot of the news media and things that are coming out, because the more information that you have, better decisions you can make. And I'm a big advocate of modeling, because in that situation, it's a great rule of thumb, a great first step, because then you can really kind of understand the different scenarios that are possible, the problems that could arise, and you're staying on top of that. And then that way, the participants, particularly at this conference, are able then to go talk to their stakeholders and be able to pivot if necessarily pretty quickly. So that's kind of critical and key, I think, as a starting point. Structuring is very, very important. It is also going to be critical. I wish I could say there's a one size fits all and silver bullet, but unfortunately there just isn't. There's a lot of variables that go into proper structuring into Canadian real estate. What asset class there is, what's the tax status of any joint venture partners, whether they're tax-exempt entities or anything like that. Is this a long-term investment? Is it a short-term investment? What is the expected income stream? And on and on and on. There's a lot of variables that kind of go in. But once you kind of figure that out, then you can kind of look into your tax toolkit and figure out, are there things that can help mitigate? Can you maximize foreign tax credits? Analysis of treaty benefits? are there domestic rules that you have at your disposal to really kind of suit your need? And I think, whether it's a partnership, corporate or trust structure that you're kind of investing in into Canada will really depend on a lot of those factors. But again, once you kind of set that out, you'll have a good structure, talk to your advisors, kind of flush the different scenarios out. You'll be poised to be in a good position to invest.
And finally, what are some of the compliance challenges that must be managed for U.S. REITs investing in Canada?
Yeah, there's a lot. I would say the big thing that I've come across with clients is that the rules around when a non-resident disposes of Canadian real estate. There's a withholding tax requirement and reporting requirement that can be administratively quite onerous, and we're trying to figure that out, working with our tax policy and government to try to change and make those rules a little bit easy. But in short, it really creates, the rule is you have to withhold 25% of the gross proceeds, which, unless you get a clearance certificate from the CRA, which says, okay, you don't have to, the purchaser doesn't have to withhold 25%, but you can get a clearance certificate where the vendor can then just withhold 25% on the net gain. The problem with that is it takes about a year to get that clearance certificate. And so as a foreign investor, the potential of, a 25% tax on your gross proceeds compared to other countries can be, quite a deterrent. Even if there's ways around that, but holding up 25% of your proceeds for a year is not something that a lot of people want to swallow or can swallow. So that tends to be sort of an issue. Now, there's ways to kind of mitigate that and structure around, but of course that creates an added complexity. So depending on the size of the investment, again, a lot of investors will say, well, I'll take my money elsewhere. So that's a concern, obviously, because particularly within Canada right now, there is a need for more investments. We have, opportunity. There's a lot of demand for real estate investment in Canada. It's tough to compete. It's a small market, so it's very tough to compete with some of the, say, tax-exempt investors that are in Canada that don't have these tax issues that I mentioned. And so there is certainly some work to do there with respect to tax policy in our own country, but I remain optimistic that we're going to get there.